Welcome to Talk Tickers. We're the place that helps you cut through the noise of earnings calls to find those actionable insights.
That's right.
And today, we are diving deep into Bowhead Specialty's Q2 2025 earnings call. This is a really critical look, I think, at a very dynamic player in that E&S market.
Definitely dynamic. The excess and surplus space is, well, it's always interesting.
So our mission today is pretty clear. We're going to break down the numbers, get into what management was saying strategically, and importantly, try to understand the market's reaction.
Yeah, because that reaction was, well, a bit disconnected from the headlines, wasn't it? Strong numbers, but a cautious market. We'll try and connect those dots for you.
Okay, let's hit that result snapshot first. Because, Bowhead really did deliver on quite a few fronts. Adjusted EPS came in at $0.37. That nudged past consensus by a cent.
Just a penny, but a beat is a beat.
Right. And revenue, $133.26 million. That beat estimates by 2.0%, and it's up a very robust 34.7% year over year.
That's significant growth. And the gross written premium, the GWP, saw a similar jump, right?
It did, up 32.4% year over year, reaching $232.4 million. So strong growth figures across the board, really.
They are. And, the profitability story looked just as good on the surface. Net income, it jumped an incredible 123% year over year. That's $12.3 million.
Wow, 123%.
Yeah. And the adjusted net income, that was up 62% to $12.8 million. And crucially for any insurer, that combined ratio improved, came in at 96.8%.
Okay, so for listeners, that 96.8% means they're spending just under 97 cents on claims and expenses for every dollar of premium they bring in. It's a key efficiency metric.
Exactly. So looking at these numbers in isolation, you'd think, wow, great quarter, operational excellence.
And yet, here's where it gets interesting. Like you said, despite these really strong headline figures, the market reaction was, cautious. Shares closed down almost 4% on the day.
Down 3.9%.
Which tells you investors were looking past just the raw numbers. And that's exactly what we need to do now, dig deeper.
That divergence is the perfect starting point. So let's get into the financial performance, the operational drivers. That 96.8% combined ratio, what really drove the improvement?
Well, the big story there seems to be the expense ratio.
Right. It's a big drop, 3.2 points down to 30.6% from 33.8% last year. Management basically said, look, we're scaling the business, we're managing expenses carefully.
And they sounded pretty confident about keeping that going, didn't they? Talking about maybe getting under a 30% run rate next quarter.
They did express confidence. And, it seems plausible. As you write more premium, your fixed costs get spread thinner. That's operating leverage. If they keep managing discretionary spending, sub 30 seems achievable.
So the driver is continued GWP growth
Yeah.
and just keeping a tight rein on cost.
Pretty much. The challenge is always maintaining that discipline when you're growing fast. It's easy to let costs creep up.
Okay, expense side looks good. But the other side of the combined ratio, the loss ratio, that actually ticked up slightly by 0.7 points to 66.2%.
It did. And that's a really key point, probably part of that market reaction.
So what's the story there? Is it just the product mix or something else?
Management was clear it was primarily a product mix shift. They're writing more casualty business, specifically excess casualty. And that line just naturally carries a higher initial loss pick, a higher loss ratio assumption than some other lines like property.
So more casualty means a higher average loss ratio, even if the underlying performance hasn't worsened.
Exactly. Plus, there's some seasonality. Q1 tends to be a bit higher anyway because of things like incentive compensation accruals. So management is framing it as strategic, not a sign of deteriorating underwriting.
But the market might be thinking, okay, more casualty.
Right.
That means more exposure to things like social inflation down the road.
Precisely. That's the concern. Is this higher weighting sustainable from a profitability standpoint, especially with claim severity trends? It's a valid question investors are asking.
Okay, that makes sense. Now, sticking with costs, there was a headwind mentioned that fee paid to American Family went up after the IPO anniversary, from 2% to 2.75%.
Yeah, that directly hits the net acquisition ratio, makes it more expensive to acquire the business.
So how much does that really matter? Management seemed to think scaling would offset it.
Well, it does matter. It puts pressure on margins. But their argument is that the benefit of scaling writing significantly more premium creates enough operating leverage to absorb that higher percentage fee. Essentially, they believe revenue growth will outpace that specific cost increase. It's a bet on continued efficiency gains.
Got it. Okay, let's shift gears a bit. Net investment income, NII, that looked really strong.
Oh, yeah, very strong, up almost 56% year over year to $13.7 million.
What's driving that? Just higher rates or more assets?
Both, really. They have more money to invest because the business is growing, especially those long tail lines that generate investable cash. And, of course, yields on new investments are better than they were a year or two ago.
And what does the portfolio look like? Are they taking big risks to get that yield?
No, actually, quite the opposite. It looks pretty conservative. High quality AA average rating, relatively short duration, only 2.8 years, which limits interest rate risk. The book yield is solid at 4.7%, and new money's going in around 4.8%.
So, prudent management there. Not chasing yield.
Doesn't look like it. They said their focus is on growing the amount of invested assets coming from the insurance business and then just finding good relative value across different sectors, not trying to time rates or reach for risky yield. They expect to add, what, $60 to $90 million to the portfolio each quarter?
Yeah, something like that. Steady growth.
Yeah.
And the overall capital position. Equity.
Total equity stood at $48 million. Diluted book value per share was $124. That's up a solid 9% from the end of last year. So building value there.
Good stuff. What about reinsurance? Any updates from the May 1st renewals?
Yeah, some adjustments there. The quota share treaty, where they share a slice of premiums and losses, ticked up slightly from 25% to 26%. And their excess of loss treaty, which protects against large losses, also increased its coverage from covering losses above 60.1% up to 65%.
And the cost for that, the ceding commissions?
Unchanged from 2024. So they got slightly more protection, it seems, on stable terms, which is positive in the current reinsurance market.
Okay. One last financial point: loss reserves. They do their big annual review in Q4 with external actuaries. Given they're relatively new in some long-tail lines, they rely a lot on industry data. How should we think about that?
It just means they have to be prudent and probably a bit conservative. Without a long history of their own claims development, especially in lines like excess casualty, they have to lean heavily on what actuaries are seeing across the broader market. It's standard practice for a newer specialty carrier. Shows they're being careful, which is good.
Right, which ties back to their whole strategic narrative, doesn't it?
Absolutely. Management kept emphasizing that their North Star is underwriting profitability. Disciplined underwriting over just chasing top-line growth. They really hammered home that underwriting matters message.
Yeah, they did. And that was reflected in the guidance or lack thereof. No specific numbers for the full year.
Right. They basically said, don't focus on a specific EPS or revenue number from us. Instead, watch the trajectory of the combined ratio, watch renewal pricing trends, and keep an eye on the tailwind from net investment income. Those are the fundamental drivers.
Okay, so within that framework, how are the actual underwriting divisions doing? Especially given that market nervousness about the casualty mix, let's break down their craft underwriting divisions.
Sure. So casualty, as we mentioned, was the big growth engine. Premium up almost 32% to $150.7 million, mostly from excess casualty. They say conditions there are still favorable, maybe a little more competition, but still good.
That's also where the risks lie, right? Social inflation, claims severity.
Exactly. Management themselves pointed it out. They're seeing claims that used to settle for, say, a few $1 million now potentially going over $10 million. That's a huge jump in severity.
That is significant.
And they also noted some headwinds in construction, which is a part of casualty things like tariffs, immigration policy changes, interest rate uncertainty, slowing down new projects. So yes, growth, but with risks that need careful management.
Okay, what about professional liability?
That was up to 23.3% to $54.8 million. It's a bit of a mixed bag there. Areas like financial institutions, large cyber liability, those are still tough. Lots of capacity pushing rates down.
But there were bright spots.
Yeah, public D&O directors and officers' liability seems to be stabilizing. They said legacy markets are starting to push back against constant rate decreases. And Markel exiting that segment actually creates opportunities for players like Bowhead.
Interesting. So some shifting dynamics there. And healthcare liability.
Strong growth there, too. GWP up 39% to $23.5 million. Still competitive, but they see positive pockets. Hospitals are seeing some rate increases because of new emerging risks, and senior care is seeing strong renewals, likely driven by some well-publicized claims activity in that sector.
Right. And finally, the tech play Baleen Specialty, their platform for smaller E&S risks. How's that progressing?
generated $3.4 million in premium. That was up over 23% just from the previous quarter, so good sequential growth. Management sounded really positive here. They stressed the tech is built, it works, it allows scalable processing with minimal human touch.
So the platform itself is ready to go.
Seems like it. They said the heavy lifting on the tech is done. Now the focus is all about scaling it up. Getting more submissions for those smaller premium accounts, $5,000, $6,000 policies, expand that flow underwriting.
There really could be a long-term differentiator, handling small accounts efficiently.
Potentially, yeah. In a very fragmented market segment, tech-driven efficiency could be a real edge if they can get the volume.
Okay, let's pull this all together now and go back to where we started that investor reaction. The strong numbers, management's upbeat tone, but the stock drops. What does that divergence really tell us?
I think it says that, at least on that day, investors were weighing the perceived future risks more heavily than the reported past performance. The shift towards casualty, the shadow of social inflation, broader macro worries, those seem to outweigh the EPS beat and the expense ratio improvement.
A classic case of looking forward, not backward.
Exactly. Taking a show-me stance, perhaps,
Yeah.
especially on whether they can maintain underwriting margins with that changing mix.
And that caution seems reflected in the stock's performance relative to the broader insurance sector, too. You mentioned it's underperformed the Kai Insurance ETF recently.
Yeah, across the 1 month, 3 month, and even 1 year timeframes leading up to this report, it was lagging that benchmark. So the market's cautious stance wasn't entirely new, but the earnings reaction reinforced it.
So moving forward, what should people watching Bowhead really focus on?
It comes back to what management pointed to. That combined ratio trend, especially the loss ratio component now. Renewal pricing, are they still getting adequate rate increases, particularly in casualty? And net investment income, will that continue to provide a strong cushion as rates potentially stabilize? Those are the key fundamentals.
And potential catalysts. What can change the narrative?
Well, future earnings calls, obviously. If they deliver another quarter with good expense control and show that loss trends in casualty are manageable, that would help. Any positive updates at industry conferences, maybe reassuring news on their reinsurance renewal, and critically, any broader signs that social inflation or loss severity trends in casualty are starting to moderate, that would be a big one.
Okay, that leads us perfectly into our This Is Not Financial Advice segment.
Always the fun part.
Indeed. So we have this situation. Strong operational results, particularly on expenses and NII, but a market reacting with skepticism, focusing on the casualty mix and macro risks.
Right, the divergence we keep talking about.
So for a contrarian investor, someone willing to look past the immediate market sentiment, could there be an argument for going long Bowhead Specialty, ticker BOW, right now?
You could definitely build that case.
The idea would be that the market has perhaps overreacted to the casualty shift and the social inflation headlines. Maybe they're underappreciating the demonstrated skill in managing expenses, that operating leverage is real and kicking in.
And don't forget Baleen.
Exactly. The Baleen platform, okay, it's small now, but the tech is proven. It's poised for scale in a part of the market where efficiency is key. That offers a long-term differentiated growth story that maybe isn't getting much credit yet.
And you've still got that NII tailwind. Growing invested balances, decent yields, that provides a nice earnings buffer.
Right. So the bet here for the patient investor is that management's underwriting discipline, combined with their tech edge in Baleen and continued expense efficiency, will ultimately win out. That the strong underlying fundamentals will eventually override these short-term market anxieties about the mix shift. It's a bet on execution and long-term strategy over near-term noise.
It's definitely a plausible contrarian take. Focuses on the execution track record and the structural advantages they're building.
Okay, so let's quickly recap. Bowhead Specialty delivered a strong Q2 on the surface. Good GWP growth, impressive gains in operating leverage, especially expense management, and NII.
But the market reaction was cautious. Focus squarely on that casualty mix shift, potential loss trends, and those broader macro risks like social inflation.
Presenting that potential divergence, that opportunity perhaps, for investors willing to dig deeper.
So the final thought we want to leave you with is this. Consider how Bowhead's focus on craft underwriting, as they put it, combined with their tech investment in Baleen, might position them uniquely, especially as the whole industry grapples with claims severity and inflation. Is the market seeing the full picture of their long-term plan, or just reacting to the immediate pressures?
Something for you to mull over. And remember, everything we've discussed here is for informational purposes only. It is absolutely not financial advice.
Please do your own research.
We hope this deep dive has helped you cut through some of the noise surrounding Bowhead Specialty. Thanks for joining us on Talk Tickers.
Stay tuned for more deep dives.